Hey, welcome to BIV Today. I am reporter Tyler Orton. And obviously, we just wrapped our own provincial election here in British Columbia last week, and a US election approaches just in the coming days. We saw a little bit of seesawing, at least in terms of how the 2016 election impacted markets in the short term. So maybe now it's a good time to think about what our investments might mean for the 2020 election that's just coming up. And I also think it's a good time to think about what the pandemic means for our investments. And with us today, we've got a great guest. It is BlueShore financial investment advisor, Claudio Chisani. Claudio, thanks for joining us on the show.
Tyler, good morning. Thank you for having me today. Fascinating topic, U.S. elections. If I can if I just quote on one of the baseball's legends, Yogi Bear, where he said a while back that the future is not what it used to be. And when he was asked to provide a little bit of context as to what that would be, he would say, well, look, I can't tell you if it's going to be better. I can't tell you it's going to be worse, but I can tell you it is going to be different. And I think this is a fantastic segue when it comes to the US elections. What's important to know is that the House and the Senate, or the power struggle in between the two, for the Republicans and the Democrats, would certainly generate interest and would have a significant impact in the financial markets. Let's look at a sweep on both parties. There will be a little bit of turbulence because new government being in complete power, it's a little bit of an unknown for the markets, and the markets will have to reconcile that. If we look at a split of power, that is generally regarded, at least historically, as a positive for the market. And if history is any guidance, if we look back at the Democratic sweep, going all the way back to the Clinton and Obama administration, 2 terms, very strong market performances, both in Canada and the United States. So if history guides us and provides a little bit of a lesson, from 1993 as an example to 2001 under the Clinton administration, equally, the American market and the Canadian market posted extremely healthy returns. We're looking at 200% plus in the American market, and that has been coupled by pretty good numbers. I think it was 178% in Canada. Those are staggering returns for an 8-year term. And I think equally in the Barack Obama's administration, we had significant returns, more than double digits in the US, and 74% in Canada. Canada was a little bit of a lagger for that period of time because of the oil crisis in 2014. So certainly we're looking forward to the elections and the outcome of the elections. I would say for the audience today that most likely an outcome that would create some short-term turbulence would be a delayed result of the elections. If we're in a situation where elections would be delayed, I think that would create some jitters in the market, at least in the short term.
Well, I'm curious, how much of an influence do kind of just macroeconomic trends have on the markets versus what an administration might have? Because concurrent with that Clinton administration that you referenced, we also had kind of the dot-com bubble emerge, and that eventually burst when we had George W. Bush come into power. That was kind of out of his control, though. And I'm just wondering what your take is on, kind of these observations that we might have about markets and how well they line up with who might be in power in an administration.
Absolutely. I think the political landscape dictates policy, and policy would affect the performance of the markets and specific sectors. So in a big picture environment, let's look at regulation. There has been a lot of talk about the antitrust and legal situations with the tech firms. Your top 5 producers on the S&P 500 have today so much power in terms of capitalizations that the 5 of them would have the entire value of the market in 2009, and that is staggering. So if you look at Facebook, Amazon, Apple, Microsoft, and Google, these specific companies would be accounted for more than 20-25% of the entire market in the S&P 500. So if there is a trend towards regulating of the tech business and the antitrust sentiment continues, I think that could be affected. It is a lot friendlier on the Biden side. However, the Republicans took a very different stance when it comes to their view of where the tech firms should be. Equally, green energy sources, renewables, as well as utilities will benefit from a Biden Democrat win, as well as energy and banking would be favored under Republican administration. We are very keenly interested in how this will play out because it will give you a little bit of guidance as to which sectors within the specific economy would perform. And to make things even more interesting, because we are in the middle of the pandemic, and the closure and the opening of the economy would also be a little bit of a barometer as to what the markets would do. So the one administration would decide to be a lot more conservative in terms of opening the economy. That would favor the technology stocks. If the other administration would say, we'll be as responsible as possible, but return to business as quickly as we can, it would certainly benefit the other 495 stocks of the S&P 500, and I think that would create a very positive sentiment as well. And you will find the client-facing businesses be a lot more in play for the next 6 to 12 months. So I think the implications are absolutely fascinating, both on the political policy front, but also how that would translate into corporate earnings for the individual equities that make the Canadian, US, and international markets.
So if I was an investor or just kind of a retail investor as well, is now the time to hedge my bets, make sure that I have a very diversified portfolio if I'm uncertain about how this election is going to play out?
Yeah, I think, Tyler, that's a really good point. You have to assess your portfolio in the context of the times that we're traversing right now. So I would say the most important thing would be to look at the risk and return parameters in your portfolio. Assess how much risk you're taking. Assess your asset allocation within your portfolio, and perhaps be a little bit cautious until we receive a little bit more clear guidance from the markets and the elections moving forward. And with that in mind, if you scout your investment portfolio, see how much you have allocated to bonds, how much cash you keep in your portfolio. That plays into the financial planning aspect of your finances. If you have a little bit more liquidity, that would certainly lend well for the future. It will offer you a little bit more buying opportunity. And if somehow the economy would close even further, it will also provide the type of cash flow that yourself, your family, your household might need. And when going one step further, if we are to look at opening it up for diversification, see how many stocks are growth related and how many stocks are value related. For the last 10 years, growth has been the unquestionable winner, and the returns have been staggering. However, value at some point would return. Therefore, being diversified in between value stocks and growth stocks would give you the optimal risk return parameters. And above all, you also have to assess the cost of doing business. Look at your overall portfolio and see if you can find a little bit more efficiency in that space. Perhaps the most interesting part of an investment portfolio right now, from a money manager's perspective, and we do have, Tyler, those discussions with our clients every day when we meet for their reviews and outlook for their money. How do we negotiate fixed income? Bonds have gone up in value, and we all would like to receive a little bit more income. However, rates of return on term deposits and cash are almost dismal. How do we bridge the gap there? And we have gone down the path of finding some alternative fixed income investments and hedging strategies that help our clients today bridge that gap and not be fully exposed to the market.
So I'm going backwards, maybe 6-7 months. I had said to myself, I don't even want to look at my portfolio for another 5 years. I'm too frightened to do that. But what was the reaction initially from a lot of clients who were very panicked, especially how the markets were initially looking, and then we saw like a big surge in the markets afterwards. It was kind of a big sway back and forth. But how has reaction been from clients just in the last 6 months?
Well, it certainly has been interesting and unprecedented time, and we expect our clients to react accordingly. There's certainly a concern from the get-go, and there's no way to sugarcoat this. There has been a lot of fear, and that's normal. The market showed it. Our clients also had to navigate this difficult time from March to April. Having said that, as soon as discussions took place about the safety of the investment portfolio, as soon as we realized that our investment portfolios are in quality stocks, equities, bonds, And we have seen an unprecedented recovery, not just in the GDP numbers, as numbers came out today. We went down for the second quarter as much as 31% in GDP. However, now we have a recovery of 34. We have gyrated from the top of the market in February, March to recovering, and NASDAQ being up north of 25% year to date. So I think the government interventions in terms of fiscal stimulus, low interest rate environment, the willingness of the entire world to participate in this, address it in a healthy way, and get everybody back on track as quickly as possible has calmed down the jitters, allowed our investors and clients to take a step back and assess, stay invested, and be able to benefit in terms of returns in the equity markets and the bond market. As a matter of fact, if you look at the majority of clients, they would most likely be in the break-even or positive rate of return if they had the patience to obviously navigate the uncertainty of February as we look at and we close the year here, moving towards November and December.
But are there any concerns that, the stock market might not be the best barometer of the underlying health of the economy, especially when you look at, say, where unemployment is here in Canada, you look at some of the GDP numbers here in Canada, and it seems sometimes that the stock market is a little bit detached from what's going on the ground, really.
Yeah, it is probably the most interesting observation. And I think our clients would share that view with you. I am certainly in the camp that the stock market represents an exclusive number of companies. So let's look at TSX 300 or S&P 500. These are businesses, for their majority, with a very strong balance sheet, able to withstand a whole bunch of turbulence, and some of them in sectors and parts of the economy that are flourishing. So we are right now in an environment where part of the economy is accelerating, and the others is in a stall mode. It's almost like driving a car with an accelerator and a brake at the same time. And I think the stock market is representing a little bit more of a representative of the accelerator than the hundreds of thousands of businesses that have been negatively impacted. These small businesses, to just give you an example, had a very tough time in this pandemic environment. And let's say at the same time, Amazon, a very strong bellwether for the S&P 500, and the tech market has been able to capture a lot of market share. And in the United States, in States of America right now, amounts for about 48% of the e-commerce in the entire country. So there will be this sort of K-shaped recovery, most likely, where certain sectors will do well and others wouldn't. And there's many parts of the economy that fall under the more troubled businesses part of the economy, where they're not necessarily captured by the equity markets, but we see them day in and day out on the ground. And they're generally small businesses. They're in sectors such as energy, hospitality, travel, and so on and so forth. And those they don't have their representation in terms of proportion into the TSX or the S&P 500. So that's the reason for the disconnect, in my opinion.
Okay, and well, you bring up some companies like hospitality industry, probably great if you did not have a lot of your money tied up in, say, those kinds of companies. But have there been kind of winning strategies that you've noticed just in the last couple of months as the pandemic has unfolded for a lot of people that have not been as hit hard by the pandemic as maybe they were expecting early on?
Yeah, it is true. Most businesses in Canada, United States, around the globe had to adapt, and we found that as earnings came in from both the United States and the Canadian counterpart stock market, we have seen, for instance, 85% of the companies on the S&P 500 beating earnings, at least the expected earnings that the analysts have projected. So that is a positive. That shows that they have done a lot of work trying to retool their business. In terms of hospitality and foods and beverages, I'll give an example quickly. Domino Pizza, I mean, this is a client-facing business. However, they decided to ramp up their online business and e-commerce to be able to cope with the reality. I think this is going to be a race for embracing technology and finding a way to run your business outside of the conventional parameters. And businesses and companies that manage to execute that correctly in a very short time span would emerge as the winners, and they may even capture a little bit more market share. So we expect the results to vary across most industries. I do feel for all industries that are troubled by the social and physical distancing rules, those business models have to be revamped and revisited, and it will take a while. And I'm reasonably optimistic that we'll receive a fiscal package. Won't maybe coming right away, but at the beginning of the year. Both the central banks in Canada and US have committed to stimulating the economy further. So the environment will be friendly. However, we'll have to certainly navigate the day-to-day turbulence and get there in the years to come.
Well, maybe I'll leave you off with this question. Go back to where we started, thinking about the 2020 election that's going to be coming up. If people are noticing some immediate reactions within the markets, some short-term impacts, should they just stay calm? Is this more of a long-term play that they should be aware of, just looking at where the stock market eventually goes, which is upwards, just on a long enough scale?
Exactly. I think we have to be mindful of the long-term trend of the market, and that has always been upwards. Regardless of politics and policies, market has a bias to move up, and businesses will eventually flourish. There will be opportunity. There will be a little bit of division in between various asset classes. But if I can go back to what clients should do, they should revisit their investment plan, as you pointed out, Tyler. They should look back and revisit their finances and make sure that they're adequately protected from a budget standpoint, have adequate amount of savings, make sure that you have that cashable term deposit or line of credit, perhaps restructure your debt to a lower rate of payment, from credit card to using a specific line of credit or lending facility, save a lot more money. And we have noticed that. We noticed from our clients that in the current environment, we have not taken that holiday. We have not had a lot of discretionary expenses. So our savings are piling up. All those are great things. And they will give us the confidence to stay the course, be invested in the market, and be opportunistic. I think that's perhaps the best advice that I could give someone who would take on the election cycle and the outcome of it. And above all, with very few exceptions, perhaps the last administration being the large exception, markets tend to have a bit of a dip and turbulence going into a new governance. It is normal. We have to find out what the new administration would require. So if you do see such drop in the market, if you do see things cooling off, it could also be an opportunity to deploy your capital, specifically if you're a long-term client with long-term goals. At the end of the day, equities and the financial markets are an incredibly well-positioned instrument to benefit for the next decade, led by a secular trend in technology, genomics, renewable energy, and so on and so forth. So we have tremendous growth opportunity for the years to come.
Okay, well, I'll have my eyes on the election results this coming week, and I'll have my eyes on the markets the next morning as well. As you mentioned it earlier on, it might actually be a while for us to get a definitive answer of what the election results are going to be. So I think we all have to be patient. But until then, Claudio, thank you so much for joining us on the show.
Tyler, thank you so much for the opportunity. I appreciate it very much, and have a fantastic day.
Excellent. Thank you. That is BlueShore Financial Investment Advisor Claudio Chisani. And that is it for the show today. But you can go to BIV.com. More interviews there, more stories there as well. In the meantime, we will be back next week. Thank you very much.